let's talk more about what investors and economists are looking for. Investors expecting the Fed to kick off a cutting cycle this week. They'll be listening closely to Chair Jay Powell's commentary for signs of how many cuts could be ahead. For more on the future of the Fed, I want to bring in John Hilsenrath, StoneX senior advisor and Yahoo finance contributor, and Paul Gruenwald, S&P Global Ratings global chief economist. Guys, thanks so much for being here. John, you do a really interesting survey of former Fed officials. You ask them all kinds of things, but obviously you ask them about policy. And I thought it was interesting in your latest, there's a pretty even split between the former Fed officials on where they think policy is going to go after this week's meeting, in terms of how many think it should stay, how many think there should be more cuts, fewer cuts. And I guess that's sort of reflective of the challenge that's in front of the Fed right now.
Right. So this is a survey I do in cooperation with Duke University ahead of the Fed's own forecast updates. And what it shows is that most former Fed officials, these are former governors, former regional bank presidents, former staff members who participated in the forecasting process, think the Fed is going to pencil in 2 rate cuts for the remainder of the year. One this week, and then the other one would presumably be in December. And this is at odds with what the market expectations is. The market puts an 80% probability of another Fed rate cut in October and then one more in December. So, this is the way I describe it. The Fed is in a position where it's more dovish now than it was back in June. So back in June, the job market didn't look as weak as it does today. We've gotten a lot of downward revisions to payroll numbers. The overall growth rate of payrolls has slowed. So the Fed is certainly more dovish. It's just not as dovish as the market thinks it's going to be. And Powell is going to have to thread that needle in his press conference tomorrow. He'll open the door to 3 rate cuts this year, but he's not going to open it so wide that people see it as a guarantee. I think he would like to have like 50-50 odds in the markets of another move in October, not 80% odds.
Paul, what are you thinking here in terms of, because as we've been discussing, there's not a heck of a lot of suspense over whether there's going to be a rate cut this week. The market thinks it's a certainty. What then do you think is likely to happen?
Well, I think the 25 basis point cut for this week is pretty much baked in. But, I agree with John. There's a lot of mixed signals right now. So we've seen the weakness in the labor market. We've been writing that the kind of foundation of the labor market strength has been narrowing, right? It's basically all healthcare right now. And, we've got mixed signals on confidence in the economy. The GDP is actually tracking 3% in this quarter. And as you reported earlier, bond yields are down. We see spreads down. We see that in our business with issuance, and equity prices are up. So financial conditions are already pretty loose. So I think, there's definitely a case to cut rates this week. And we have one more penciled in for the rest of 2025.
Well, and Paul, as we know, interest rate policy is kind of a blunt instrument, right? It's not a precision tool here. And so how much upside is there, given, as you say, financial conditions are already pretty loose? How much is a cut going to help the labor market, and how much is it potentially going to exacerbate the inflation issue? Right.
Well, inflation is going to be tricky, right? Because all the inflation measures have picked up, whether you look at PPI or CPI, and we know that the tariffs are going to feed through. Chairman Powell thinks that's a level effect, and we agree with that. The optics aren't particularly good right now, but it's really back to financial conditions. That's what maps into GDP growth and ultimately labor demand. So the Fed rate cut, which is baked in already, is going to help, but it's really the financial conditions, equity prices, bond yields, and spreads that are going to be mapping into the macro outcomes.
And John, we have talked also a lot about the changing face of the Fed in terms of the players there. As Jen was just talking about, even at this meeting, is Stephen Miran going to be in there? We don't know. I guess there's still a chance Lisa Cook, depending on the outcome of this back and forth in the courts, might not be in the room, but it seems like she probably will be. And I was struck by, again, going back to your Fed survey, that Christopher Waller was overwhelmingly the choice of the folks you surveyed. Is that just sort of institutional bias, perhaps?
No, well, no, I think what they see, well, maybe there's some institutional bias because Chris Waller is a Fed governor. Not only is a governor now, he used to be the research director at the St. Louis Fed. So what I do is I'm surveying these former officials. I got 25 responses. 21 of them said that Chris Waller was the best choice among the 4 people who are most commonly cited as on the short list for to get the job after Powell's term ends. And what everybody said is that they thought that Waller was the most likely to be an independent decision maker, which is another way of saying least likely to be overly influenced by the White House about what the interest rate should be. And now, so here's the twist. Because he's seen as someone who's independent minded, a lot of the people who said he's the best candidate don't think he's going to get the job. Among the other candidates that we put out there, Kevin Hassett, who's seen as a front runner, the National Economic Council chair to the president, he got 0 votes. Not a single former Fed official said they thought Kevin Hassett would be a good choice.
Paul, what are you thinking here about, who's going to be the next chair of the Fed?
Yeah, well, we're not going to jump in on the horse race, but I think I want to underscore the importance of Fed independence. I mean, the market puts a huge weight on that. That's a huge institutional advantage of the U.S. So I think any choice that preserves that independence and all the benefits that come with that is a good one.
Paul,
hey, Julie, can I throw in one other
Sure.
point here? In this survey, we also found overwhelmingly former officials thought that there was a serious risk that the Fed was going to make a policy error over the next few years because of a loss of independence, because the board might be stacked by loyalties to a president who wants much lower interest rates. So the reason they're so overwhelmingly coming out for Waller is because they think he'll uphold some independence. And here's the important point is I think this probably reflects the market's preferences too. I think Waller would be seen as someone in the marketplace who would make sound judgments. And if the White House comes to a view that it's got to reassure the markets, we might see Waller sneak up in this race and land a job that a lot of people think he's still kind of in the back of the pack on.
Paul, how concerned are you about the policy mistake potential?
Well, the thing to watch if that's going to happen is medium-term inflation expectations, right? Expectations of inflation in the U.S. are pretty well anchored around 2%, and that has lots of benefits. For example, right now, Powell and the Fed are looking through the tariffs as a one-time increase with no second-round effects. If we start to see a perception of inflation bias in the Fed, let's maybe that's a loss of independence, that's going to make their job in getting the 2% inflation target much more difficult in the future. They're going to have higher rates, tighter financial conditions, and probably slower growth.
Fed week is here, and 1 rate cut is a base case, maybe even 2 though. But the big question is not how many, it's the story. Is the Fed taking a little insurance out, or do they need a fire extinguisher because something's burning? And that's what we're breaking down on today's Stocks in Translation. First, a quick definition. A rate cut is when the Fed lowers its short-term policy rate. A single cut is 25 basis points or 1/4 percentage point, and a double is twice that, or 50 basis points. And note that we're talking short-term rates only, not the ones that affect your mortgage. And when it comes to rate cuts, there are 2 different flavors. First, there are insurance cuts. That's when the economy is okay, though it might be slowing down. Bank stocks and smaller company stocks are holding steady, and the Fed is cushioning risk early. But sometimes the Fed is making a behind-the-curve cut. Data is worsening. Credit gets nervous along with those bank stocks. In this scenario, the Fed is chasing a downturn in the making. So let's set up these possibilities in a chart. This chart comes from Brian Levitt over at Invesco, and it shows how the S&P 500 typically behaves around the start of a Fed rate cutting cycle going all the way back to 1970. Note that horizontally, the chart begins 12 months before the first rate cut and extends to 12 months after that cut. Vertically tells you how much profit or loss is. Now, the first scenario in white tracks what happens to stocks when the economy is already in recession when the cuts begin. That happened 4 times since 1970 and actually produces the best return, 28%, though it's a little bit bumpy after that first cut. Secondly, the green line shows what happens when the economy falls into recession within a year after that first cut. This is the worst case scenario for stocks, which happened 6 times and produced an average loss of 13%. Finally, in blue, we show what happened when there was no recession. This happened 6 times and boosted stocks by nearly 20%. It's also the smoothest sailing for stocks. Unfortunately, we almost never know until we're in a recession or after it's already started and ended. So all we're showing with this chart is that stocks prefer Fed insurance cuts, and they don't like to see a recession sneak up. But we can point to some markets that will give real-time indicators if the Fed is starting to lose control and becoming reactive instead of proactive. Now, right now, markets are behaving like there's an insurance setup. In this chart, we're showing 3 things that are interest sensitive: small caps, bank stocks, and home builders. Critically, all of these have been heading higher over the last 3 months. But according to Michael Hartnett's team over at B of A, there are some key levels to watch in 2 of these. For the Russell 2000, tracking small caps, watch the 2400 level. Right now, we're just barely above it. Ideally, you're going to see this market rally from here. But if it decisively breaks below 2400, that means there are some problems, says Hartnett. Then watch the KBW Bank Index. It's just over 150 now, and we don't want to see it below 140. Simple enough. You can monitor both of these on the Yahoo Finance site and mobile app. And finally, B of A says it's important to watch corporate credit, specifically something called the IGCDX index, which heads higher when companies are facing borrowing stress. If you don't have access to it, just watch out for headlines that are about corporate credit breaking down. Now here's a recap of what to watch next. 1, pay attention to those critical levels in small caps and bank stocks. Then watch the Fed decision this Wednesday. If the Fed goes double, guess what? That might mean they're a bit fearful and behind the curve. Then watch those jobs reports. Last week, the weekly unemployment insurance number, it jumped to a 4-year high. If that trend continues, watch out. And finally, pay attention to headlines about corporate credit freezing up, because right now, money is flowing like water. Bottom line is, rate cuts are not necessarily a free lunch, so context matters when it comes to what the Fed decides this Wednesday. And tune into Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast.